You think all your investment income is taxed the same? That's a simple mistake that could be costing you thousands of dollars every single year. Most investors are laser focused on the return, the big flashy number that shows how much their portfolio grew, but they completely ignore the silent wealth killer hiding in plain sight: taxes. What if I told you that two investments, both earning you $1,000, could hit your tax bill in wildly different ways? One might cost you $3,700 in taxes, while the other costs you just $1,500. That's not pocket change. That's a few dinners out, a plane ticket, or more importantly, hundreds of extra dollars that should be in your pocket, compounding for your future. Because after all, it's not what you make, it's what you keep that matters. We're about to break down the huge tax difference between dividends and capital gains to show you which strategy actually builds wealth faster. This isn't just about saving a few bucks this year. It's about fundamentally changing your financial trajectory. By the end of this, you'll understand the playbook that the wealthy use to keep their tax bills low and their returns high, and you'll be able to use it for yourself. But first, I'm Brad Lineberger, certified financial planner and founder of Seaside Wealth Management, helping you get more out of life with your money. If you'd like guidance on building a financial plan, use the link in the description below to book a free strategy call with one of our advisors. Now let's talk about dividends and capital gains, how they're taxed, and how to keep more money in your pocket. Before we get into the nitty gritty, let's make sure that we're all on the same page, because you got to know the players in order to win the game. First question is, what's a dividend? Think of a dividend as a thank you check that is given to you by a company or an ETF that you own. Basically, they're giving you a piece of the profits that are rightfully yours, because when you own a stock, you own a company, which means you own a business. And as the business owner, a dividend is basically a distribution of the profit that goes to you. Now, on the other side of the coin, we have a capital gain. A capital gain is simply the gains that you realize when you sell an investment in your taxable account at a gain. So let's say you paid $100 for a stock. It's now worth $200 and you sell it. The $100 difference there, those are gains, and you're going to pay taxes on the gains or the profit from making the trade. Okay, this is where it gets really good. This is where we talk about not just what you make, but how you make it and for how long you own it, because this is about how you keep more of your dollars in your pocket. And let's start with dividends. There's two different flavors of dividends. There's qualified dividends and there's ordinary dividends. And you need to know the difference because it matters. Every year you get a 1099 and it shows you what your total dividends were for the year. And then there's a little box there that says, of the total, how many of these things were qualified? Well, here's the difference. An ordinary dividend is a dividend that's going to be taxed at your income tax rate, whereas a qualified dividend is qualified to be taxed at the lower capital gains tax rates, which are going to be either 0%, 15%, or 20% based on your income. The key is to know what makes a dividend considered qualified. You have to know that in order to position your portfolio correctly. To be qualified, you have to have owned the dividend for at least 60 days in a 121-day period. So there's a holding period requirement. And typically it needs to be a US company, typically a large US company, in order to be considered qualified. But if it is qualified, the tax treatment on those qualified dividends is much more favorable than the tax treatment on your ordinary dividends. Now for capital gains. The IRS follows a similar logic, but slightly different. There's two kinds of capital gains. We have short-term and long-term. So a short-term capital gain is a gain that you realize for a holding period, so you've held the investment for less than a year. In order for the gain to be considered long-term, it needs to be held for 12 months and a day, or slightly over a year. And the difference is really important because short-term capital gains are taxed at your ordinary income rates, which could go as high as 37%. Long-term capital gains are taxed at the lower 0%, 15%, or 20%, depending on income. Most middle-class Americans find themselves in the 15% capital gains bracket, although when you first retire, you may find yourself in lower income brackets early in retirement. There is a chance that you could sell capital gains and pay nothing in taxes if you play the tax game correctly. Do you see the pattern here? The tax code rewards patience. Whether it's holding a stock for a little over 2 months to get a qualified dividend or holding it for over a year for a long-term gain, time is the most powerful tool that you have for cutting your investment tax bill. Now for the aha moment. Let's run the numbers. Now for a real-world scenario here to help bring this home. Let's meet Jane. She's a single tax filer earning $80,000 a year, which puts her in the 22% ordinary income tax bracket. When it comes to capital gains, she's in the 15% capital gains bracket. And for this year, she's got $10,000 of dividends. The dividends, if they're ordinary dividends, she's going to pay $2,200 in taxes because that's her tax bracket. And so things that would give ordinary dividends might be real estate investment trusts or REITs, could be some of the international investments. But if all of those dividends were qualified, now at the 15% capital gains rate, those dividends are taxed at $1,500. That's a $700 savings that gets to stay in Jane's pocket and doesn't go to the IRS just because she knows the rules, she positioned her portfolio correctly, and she has the more tax efficient qualified dividends. Now let's talk about Jane as the growth investor. Let's say she made an investment and she had $20,000 of capital gains and she didn't wait the full 1 year holding period before making the trades and realizing $20,000 of profit. All of that would be taxed at her ordinary income rate, which is 22%. So of the $20,000 of short-term gains, she's going to pay $4,400 in taxes. But if Jane was patient and she let the gains season a bit to at least a year and a day, now she's only going to pay $3,000 in taxes on the $20,000 long-term gains. That's a $1,400 savings on the same investment and the same profit just because Jane knew the rules, she was patient, and she used the rules to her advantage. Now, for those of you with higher incomes, there's one more layer that you absolutely have to know about: the net investment income tax, or NIIT. This is an extra 3.8% surtax that hits investment income for individuals with modified adjusted gross incomes over certain thresholds. So for 2025, it's $200,000 for single filers and $250,000 for married couples filing jointly. And heads up, these thresholds are not indexed for inflation, meaning more and more people get hit by this tax over time. So the 3.8% is taxed on top of the tax rates that we just talked about, and it applies to the lesser of your net investment income or the amount of your income that exceeds the threshold. So if you're a high earner in the 20% long-term capital gains bracket, your actual federal rate isn't 20%, it's 23.8%. If you have a short-term gain and you're in the top 37% bracket, the total rate would actually be 40.8%. So this makes tax planning even more critical. The gap between short-term and long-term gains is no longer just a few points. It can be a tax savings of nearly 17 percentage points. That's a massive difference that can seriously accelerate or stall your journey to building wealth. So what do we do with all this? How do we use this to build wealth faster? The answer is to make tax efficiency a core part of your strategy, not just an afterthought at tax time. So first, if you're a dividend investor, your mission is simple: get those dividends to be qualified. And when you buy a dividend stock, be mindful of that 61-day holding period. Don't sell a great company right before the dividend qualifies just to lock in a tiny gain. So that tax savings will oftentimes be worth much more. Second, if you're a growth investor, your new favorite word should be patience. And that 1 year mark is your golden rule. If you have a winning stock that you've held for 10 or 11 months, ask yourself, do I absolutely have to sell this thing right now? Because hanging on is going to give you the better, more favorable long-term capital gains tax treatment. And an even more advanced tax strategy is something I like to call tax loss harvesting. So this is the process of when the markets are volatile and markets are down, you can sell any investment that's at a loss or underwater and realize a tax advantage for doing that. And what you do is you replace the investment that you sold with something that's similar, but different enough to avoid the wash sale rules. So that way you can participate in the market recovery that eventually happens, but you also get a tax benefit. And how you're going to use that tax benefit from any loss that you realize, you can write off up to $3,000 per year from your adjusted gross income. And you can also carry those losses forward into the future to use to rebalance your taxable portfolio tax-free all the way up to the amount of losses that you realize. So years like 2022, 2020, 2018, even earlier this year in April, when markets were really, really volatile, doing tax loss harvesting allows yourself to, as we say, make lemonade when the markets give you lemons. And the goal here isn't just to pick one strategy, dividends or capital gains. The goal is to have a blend of everything in a really well-rounded portfolio. So you do need dividends. You do need capital gains. You also need some interest income. That's what a healthy portfolio looks like. And on that note, just a word of caution here. While I love qualified dividends as much as anybody else, I also want to point out that you really don't want the entire portfolio to be qualified, and here's why. That means that you've essentially put the whole portfolio into one asset class, typically large US companies. So I want most of your portfolio positioned that way, call it 70, maybe 80%. You need to have a small little piece of the portfolio positioned in other things like international large, international small, emerging markets, real estate, maybe some fixed income. But this is where a strategy comes into play called asset location. You can put the less tax efficient investments, like those that I just mentioned, that don't have qualified dividends, put those in your IRA or your Roth IRA, locate them in accounts that are going to be sheltered from taxes, put your most tax efficient investments in your taxable brokerage account. That's called asset location. And that, again, helps you keep more of your hard-earned dollars in your pocket and less in Uncle Sam's. All right, let's bring it all home. The tax code rewards patience. Just like I tell my kids, if you want anything good in life, you gotta be patient. Whether it's holding that dividend for at least 61 days to make it qualified, or holding the investment for at least a year and a day to make it a long-term capital gain, be patient with your investment decisions, and the tax code will reward you. And the resulting outcome is that you're going to keep more money in your pocket and build wealth faster. And no matter how you invest, we think ETFs are the best way to go. For a great video on that, check this one out here.